Good afternoon. Happy Friday, June 7th. Mark Milam here, your mortgage professional. Man, what a great week we were having in the mortgage market until we get to today, Friday. Let's take a quick look at what's been happening with mortgage-backed securities. I'll zoom into the most recent 30 days. And this was the run-up this week. So we finished out last week, Thursday, Friday here in positive territory. We continued. Mortgage-backed securities continue to gain ground on the first 3 days of this week. That means interest rates were coming down. Pricing was improving. Yesterday really was just a plateau because we hit this line of resistance. It was just going to take something a little extra to get us to bump through this line and head for even further lower rates. And we had our hopes pinned on a labor report from the Bureau of Labor Statistics that's coming out today, non-farm payrolls along with unemployment. We've gotten some weaker indications from data as the week wore on. We got job openings coming in lower than expected. We had the ADP employment report coming in lower than expected. So we were hoping, and most economists were projecting, that we were going to see a lower than estimated non-farm payrolls number, meaning the country didn't add as many jobs as consensus estimates would tend to indicate. And that did not happen. We actually added 272,000 jobs in the past 30 days against a consensus estimate of 185,000. Oof, that's the wrong way. And that's why we're seeing mortgage-backed securities sell off on the day. Now, that thin line will tell you how far down we sold. We were really worse this morning. We've gained about half of that back. Why have we gained half of that back? Well, maybe there's some idea here that the unemployment rate actually ticked up. The unemployment rate, and this is a little odd and counterintuitive, the unemployment rate actually went up from 3.9 to 4%. And so how would the unemployment rate go up if we're adding more jobs than we anticipated? And here's the interesting thing about labor markets. So if you're not looking for a job, then you're not really counted in the unemployment number. And so even though we added more jobs than we anticipated, there's now more people who are actually looking for work, which would tend to indicate that maybe some of that stimulus pandemic savings is starting to run dry, and we have more and more people out there looking for work. Now, it's a 0.1% increase in unemployment. It's not a huge move, but it is a move upward, which would tend to indicate, hey, folks are running out of savings and they're out there looking for jobs, looking for work, and they're starting to work more. That in and of itself is sort of a silver lining in this cloud, and that's the reason why we haven't worsened even further than where we did this morning. We've actually gained back a little bit of what we lost, and that's good news. If we take a look here at the FedWatch tool, this is the traders, what they're projecting for a Fed rate cut in June and July. Well, really, today's news is going to take any sort of idea of a Fed rate cut in June or July off the table. It's just not going to happen. If we had gotten a number that was below consensus estimates, you could make an argument that the Fed would cut the Fed funds rate in July and then probably leave everything alone as we move into the election period. The Fed does not want to be seen as a political instrument, so odds are they're not going to be adjusting the Fed funds rate in September or November. But we were keeping our hopes up that we would see a Fed rate cut in July, and this hot labor report today is going to take that off the table. We're not going to see a Fed rate cut certainly next week in June, and we're probably not going to see one at the end of July. We can see the traders are forecasting 99.4% chance that the Fed will keep the Fed funds rate steady on June the 12th. And then if we go here to July 31st, it's now a 91.1% chance that the Fed will do the exact same thing at the end of next month. And then our next meeting out to the 18th of September, right now, maybe about a 50% chance, or 46% chance, I should say, that the Fed would be cutting rates in September. But that's getting awfully close to the election for the President of the United States. And I would be a little surprised if we see the Fed get in there and start to alter the Fed funds rate within 60 to 70 days of our national election. If I can be of any service to you over the weekend, don't hesitate to reach out, mark.milam@highlandmtg.com. Have a good weekend.